In this lesson, we move on to the next part of Wyckoff theory, which is the complete structure of accumulation and distribution. This is the core of what Wyckoff theory centers around. But if you've seen this before online or you've read about Wyckoff, you've probably been taught wrong. So really important that you listen to this, because the modern world does not act the same as the previous times. Wyckoff theory goes back to the early 1900s, when Richard Wyckoff, the creator of the theory, was alive. Back then, markets were very different. The theory of accumulation and distribution was originally based on the stock market. And the core theme of it was that smart money would seek to accumulate all the available supply of stocks at a bottom before launching a campaign to push the market higher before selling it in distribution. The modern world is different in that we now have what are known as financial derivatives. A derivative, such as the perpetual futures that we use in crypto, is not fixed in supply. A derivative is a contract between two traders, one long, one short, and the number of potential contracts that can be exchanged is unlimited. Use Bitcoin as an example. It is not possible for smart money to just accumulate all the coins because that only deals with the spot market. Yes, there are a maximum of 21 million Bitcoin, but on derivatives, perpetual futures, there is a potentially infinite number of contracts, meaning that if you're trading any market which has derivatives, you cannot just look at the process of absorbing all the coins, but you have to also look at the aggression or the lack of interest between buyers and sellers as an indication of where the market is going to go next. So we do this through analysis of positioning and flows. The way we frame this is that in the accumulation phase, instead of just thinking about sucking up all the coins, we look at it and say the accumulation phase will end when most of the market is positioned in one direction, which is long. And distribution will end when most of the market is positioned short. At that point, whenever they're all long or all short, one side will show aggression through their flows, while the other side will show a lack of interest. For accumulation, this is when the path of least resistance shows to the upside and the bulls take control, while bears basically decide to stop fighting the trend and give up. In crypto, you can find coins that have no derivatives. And in those coins, the original principle will apply. If you look at something on Uniswap that doesn't have any markets on Binance Perps or Bybit, then yes, it's spot only, and you can use the just soaking up supply. And many traders can find profitable strategies by just doing that. But to trade the main coins, pretty much any coin you've heard of and any coin that's on the big exchanges, you also need to understand positioning and flow. So before we move on, let's summarize Wyckoff theory. It gives us further confirmation to what I spoke about in the very first lesson of technical analysis, which is that price is everything. And it's very important to note at this point that the schematics alone are useless. If you just overlay a schematic onto a chart that you've seen from Google or you've seen from the ones I provide, it is not enough. That gives you an idea, but it doesn't give you the full picture. The three laws of Wyckoff must be respected. Supply and demand leads into cause and effect, which in turn builds into the effort versus result. Supply and demand is purely determining price. That is why price is everything. That is why price is still the fundamental core of this. Your fair price is determined through the supply and demand dynamics. That is what stops an uptrend or a downtrend, and that is what causes the subsequent move. Moving through to accumulation and distribution, seen as cause and effect, we determine that through both the schematic and the positioning of the traders over time. And finally, before we make a move, before we break out of accumulation and into a trend, or before we break down from distribution and into a trend, we have to see the aggression, which is the effort and result. And we can analyze that through volume and flows. So by putting all three together, you get a true picture of, is the market in a technical frame, meaning is this truly accumulation and distribution that will lead to an uptrend or a downtrend, or is it just a lack of interest that's moving nowhere? By knowing all three, you can then begin to analyze and accurately forecast where the market will go next with higher probability. So let's take it further, move through and explain positioning and flow for you, and then get into all of the different schematics, the different ways that accumulation distribution can appear on the charts, and how you can spot it in any asset.